The next session is on Australian Equities. If I can have everyone come up to have the panel discussion. This is hosted by Blake Hesford from MLC Asset Management, and I'll let him do the rest of the introductions.
Thank you, Francie. So I have the pleasure of hosting the Australian Equities part of this discussion today. Whether we like it or not, Australian Equities are and continue to will be the most discussed part of any client portfolio. I think the really interesting piece is with the backdrop of a weakening China, the RBA cash rate cuts on the horizon, and some really interesting insights off reporting season. What does this all mean for Australian equities? I'll now pass to John Guadagnuolo, Portfolio Manager at Antares Equities, who'll provide his view on what this investment future may look like. John's joined on the panel today by Melinda White, Portfolio Manager at Longwave Capital, and Martin Crabb, Chief Investment Officer at Shaw & Partners. Over to you, John.
So I've just got a little challenging thesis for you, and it's about interest rate cycles. And we hear a lot about them, and you hear a lot about people saying, oh, we're going to have interest rate cuts and we're going to have all sorts of fireworks as a result of that. It'll do this, it'll do that. Well, will it? I don't know. So the market itself, if we look at the US fixed interest market and beginning tonight, they're expecting around 10 cuts of 25 points over the next 18 months. Now, there's a reason that this has sort of come to see there's some weakness in the US economy, but it's not materially weak. And what's also interesting is that we're not really seeing. Here are the rate cuts. Sorry, I'm looking at the wrong screen. I was talking to my compliance screen, which of course is heavily important. But as you can see from that's there, the market is looking at 10 cuts in total over the next 18 months. So they're kind of expected, and we start tonight. There's a bit of debate. Will it be 25 points or will it be 50? But what's interesting is this is being done at a time when global financial conditions are not particularly tight. So yes, we've had rates go up. Yes, we've had the inflationary impact post-COVID. There was a lot of debate. Was it transitory or not? And it seems most likely in most countries it was transitory. And you can see that, obviously we've got a degree of financial flexibility where the blue bars on that chart are positive. When they go negative, that's when things go bad. Well, they're not negative. They're quite robust. People are not short of capital. There's plenty of capital in the market. And if we look at things like employment, this is the Australian unemployment rate. The US one is similar. Yes, it has picked up, but it is a long way behind where it averaged pre-COVID. So people have got jobs. The reason I'm going through these points is that typically rate cuts provide liquidity. They typically free up sort of pent-up demand, that type of thing that's there, and they often are in response to a crisis, be it liquidity or be it confidence. And whilst confidence is not strong, it's not at crisis levels. And as I say, people have got their jobs. And this was borne out in the recent reporting season, where, interestingly, what we have on this chart, it's a little complicated, but effectively these are the companies that we cover. And so these are the number of companies that we're reporting across the various sectors of the market. The green bars represent the percentage of those firms in that particular sector that reported in such a way that saw the share price appreciate by more than 5% from the date of report to when I did this table, which was the 9th of September. And the red bars are those that disappointed. And what's interesting is that you can see, communications discretionary are relatively evenly poised, which is what you'd expect in a kind of a balanced economy. They're not particularly disappointing. They're not one way or the other. The sectors that really missed were the hard parts of the economy. Energy, hopeless. Materials, hopeless. And they're not going to be impacted by interest rate cuts. And in fact, within materials, one of those green bars is James Hardie, which is in the United States predominantly. And within the industrials business, which also suffered a bit, one of those is Qantas, which people see as a bit of a proxy for consumer at times. So you're kind of looking at a situation whereby yes, rate cuts are coming, but we're not in a situation that seems that depressed that they might spark this cyclical rebound that we often see in this situation. So what impact could they have? And this schematic represents something that sort of showing if a company was to earn $10 versus a company that was to earn $7.75, and I chose those numbers because they added up with the discount rates. What this is demonstrating is as rates are cut, the discount rate falls. And what that suits is the longer duration growth assets. So the red bars or the orange bars represent the company growing at 4%, the blue at 2%. And what you see is that as rates fall, the higher growth company is worth more today than it was from the starting point, which is weighted average cost of capital of 10%. So in other words, I put it to you that the strongest impact that we might get from these rate cuts might actually be to favour longer duration assets because their future cash flows will be worth more in today's terms rather than any cyclical rebound that historically is associated with rate cuts. So with that, I've done the summary and I will hand it back to Blake.
Thank you, John, and please join us in the chair. Interesting perspective. There's been a lot of discussion this morning, earlier in the day, around thematic investing and based off what you're saying, long duration growth seems to be the winner. Is it as simple as just picking a growth factor ETF?
There's nothing worse than holding a growth stock that goes wrong because when the PE, obviously PEs inflate and they deflate too, so you cop the double whammy. Obviously we don't pick everything correctly, unfortunately, but at least we try to avoid the losers. And, in growth markets, when things go wrong, they go badly wrong. And anyway, we could actually be wrong. Right? So, the reality is that that's a thesis, but it's only a thesis, it's not a fact.
Melinda, Longwave, you're a bottom-up manager, small-cap manager. Do you have a house view on rates and your thoughts on John's observations?
So as you mentioned, we're a bottom-up manager. We're actually really solely focused on the bottom-up, although we do run a very different investment process to most small-cap managers. So we combine systematic stock selection and portfolio construction methodologies with fundamental investing methodologies as well in order to run a more diversified portfolio across the small-cap space. And as a result of that, we don't actually embed any interest rate forecasts or views into our stock picking or portfolio construction. That said, what really matters in small caps is that you select a basket of stocks that are going to survive in all market conditions, and that is one of the things that we do embed in our stock picking. And survival for small cap stocks is partially dependent on how their balance sheets look, right? So we look for companies with stronger balance sheets, and we take a realistic view about where rates might be in the medium term when we're doing our fundamental overlay and investment, analysis, looking at the specific stocks that we own in the portfolio.
Thank you, Melinda. Martin, being the only asset allocator on the panel, and I guess your view on John's position and how are you thinking about constructing the Aussie equity part of your portfolios?
Yeah, well, I suppose a bit of a get out of jail free card because we run an income strategy, a core strategy and a growth strategy within Aussie equities. So I've got to wear three different hats. But I think from probably the core perspective, what John's talking about is, there's a whole bunch of interest rates coming. That should result in lower longer term interest rates, which is what the market really cares about. The market doesn't discount off cash rates, it discounts off typically longer term bond rates. And I suppose my question is why are rates coming down? Is the inflation dragon slain? Are we going to get a soft landing? Is the Fed going to cut by 50 points tomorrow night, or is it going to cut by 25? All that sort of stuff. That's kind of short-term sentiment. I think the bigger issue is where are long-term rates? So inflation expectations now anchored at a level that the Fed's done its job. The RBA is probably going to do its job next year. and we can get lower long-term bond rates. And I think we've kind of seen that. We've seen a significant rally in the 10-year from almost 5, in John's chart, from almost 5 down to 3.5. So we've seen a PE expansion. We've seen it globally, and it's not just driven by higher expected earnings, although that's driving the US market. We're seeing it in high PE ratios across a range of, look at the banks. So you couldn't call CommBank a growth stock, but it's on 25 times earnings, right? And that's just lower long-term bond rates. So have we seen that already would be a question mark I have. I think you make the statement that I'm the only asset allocator. I think everyone's an asset allocator. It just depends on how big your asset class is. You're still allocating. So you still got to think about where rates are going. We're typically at the moment trying to run a neutral view on rates and where they're going and not have too much a bet either way, because we're looking at something that's never happened in history as being the most probable outcome that's priced in the market, which is you get a soft landing, you don't get a hard landing, and the central banks for the first time in history have managed to get inflation down without killing the economy. And the SARM rule's not going to work this time, so the unemployment market starts to soften, then crack. Every other time the Fed's cut rates, it's cut them too late and we're already into a recession. So we're sort of the market's betting on something that's never happened before, which is always a dangerous proposition. So from an asset allocation perspective within the equity strategy, I think you've got to be a little bit nimble and maybe like Catherine, just not have a view, or at least if you have a view, have it hedged in case you're wrong. I think that's probably the best way to play it.
I think that, as mentioned around the question around the ETF thing, ultimately you've got to forecast the earnings of the company in some sort of accuracy. And I think the point that I'm making is that think less about what might impact the valuation and more about what drives the company, and ensure that that's where you're focused. Because the point of those charts is that the valuation, when I say valuation doesn't matter, I don't mean infinity is fine. What I mean is that the idea of a re-rate or a de-rate is going to be much more dependent upon the earnings of that particular company than it is upon any kind of macro surround. And that's really what is driving our process and our thinking, because that's kind of what we do. We run concentrated portfolios.
I might also pick up on Martin's comment about not taking a view, and I might be talking to John and my own book here, but one observation I would make is that the large cap part of the market has really outperformed in Australia. So Australian equities overall have obviously gone up, but that's largely due to large cap. Small caps have underperformed large caps for a very long period of time now. We're 25, 26 months through a relative drawdown in small caps. I don't know exactly what it looks like for the mid-cap space, but the observation that I would make is that obviously if we are going to be entering a rate cutting cycle and we've actually avoided recession, growth assets, which is very much, our space, small cap companies tend to be nimble in new industries and growing, and both of us focus on the bottom up, and we're looking for companies that are growing their earnings strongly over the medium term and are reasonably valued. That seems to us, I think, to be a pretty obvious space to be invested in.
That's what we think. In terms of the SARN rule and all these rules that are apparently being broken and not been seen before, well, COVID hadn't been seen before either. I think that's, and we didn't really understand that impact on supply chains and how that worked through the inflationary impulse. And the other thing that has happened, I think, is that central banks have had sort of a long time since Paul Volcker decided to smash inflation back in the 1980s with interest rates to work out how to better do it. There's a whole number of things that I could talk to around changes in industrial relations laws. Point is, people remain employed. One of the reasons I'm not going to justify CBAs 25 times because that's, from a mid-cap perspective, that's a normal multiple. But it's certainly not one you'd think for a major bank, but it's geared at 8 times. But the thing about with changes in industrial relations laws, not just here in Australia, but globally, it's a lot more difficult to make people redundant. And so people keep their jobs, and that's why bad and doubtful debts haven't moved up, I suspect, appreciably, because people are still employed and the mortgage is their first thing. So they've made sacrifices elsewhere. But we're not seeing that. The point about those discretionary companies through reporting season, the discretionary sector was one of the best reporting parts of the market. And it wasn't just because it was better than expected and expectations were low. That happened in February. This time around, the expectations weren't as low. And some of those companies reported quite decent outlooks, like JB Hi-Fi and Super Retail Group in our space in particular.
Thank you, John. And you've each kind of touched on it, maybe unprecedented. I think there's a consensus that we're at the start of a rate cutting cycle. Other foreign central banks have done that. Will it be 25? Will it be 50 overnight? Domestically, not as certain as to when that'll come. The market's pricing in some cuts before Christmas. RBA saying it won't. We look forward to May. They're pricing in 87 basis points. So we're expecting rates cuts to come through. What if we're wrong? What if inflation, in particular in Australia, remains sticky? And I might pick it up with you, Melinda. You spoke about the lower interest rates really being a beneficiary, or small caps being a beneficiary in that relative underperformance. But if inflation remains sticky, how do you adjust portfolios? Or I know you're a bottom up, and I probably guess what the answer is. But just thoughts on if we're all wrong.
Yep. Okay, so if inflation stays sticky, you want to be invested in companies that can execute in all kinds of market conditions. And from our perspective in small caps, you want to be in companies that are going to be able to survive, and through a period like that. And to our mind, what that means is that you need to be invested in quality companies, which is what we really focus on, both on the systematic side of our stock selection and also the fundamental side of the analysis that we do. It probably will benefit gold stocks, which are currently cheap and, printing a lot of cash in this current environment. And you really want to focus on balance sheets. Obviously, if inflation stays sticky, then interest rates stay higher, and you don't want to be invested in a company that is slowly moving into a train wreck with their balance sheet, which are the things that we focus on when we're looking out into the medium term for our companies from a fundamental perspective. But I would also say small caps are 26 months into a relative drawdown versus large caps, and are looking, very, very interesting relative to large caps in Australia. And the median active manager in Australia has outperformed both their benchmark and the ASX 300 over 30 years of data. So it is a space to be, looking at.
And there was a lively discussion this morning, Melinda, which you might have not been privy to, around benchmarks and small caps. Martin, your view around if interest rates were to stay higher?
Yeah, I mean, it's probably the thing that should be keeping most managers up at night is what if we're wrong on inflation. And going back to the 1970s and 80s, where we had a second oil crisis and it kicked off another bout of inflation, and then Paul Volcker had to save the day, so to speak. So 2022 is a playbook for how to play high inflation. So stocks and sectors that did well, obviously energy. So what could cause another inflation outbreak is the Middle East and Ukraine worsening at the same time. Maybe it's based on Trump pulling out of NATO or whatever. We really don't know. But that's probably the existential risk, is that we get another supply side issue or some massive commodity energy spike, which has caused the last kind of inflationary outbreak. And then it gets stuck in the system with wages and prices, etc. So 2022, energy stocks, gold stocks, to Melinda's point, they're a geopolitical risk hedge as well as an inflation hedge to some extent. And then when the Aussie market, you've got this pricing power factor. At Shaw and Partners, we think of the Aussie market as having a pricing power factor. And you can look at those companies that have quality like high ROE, sustainable business, high recurring cash flows, but also the ability to pass on higher costs to their customers. The ultimate pricing power stock is Transurban, because its tolls are linked to inflation. So it loves, when inflation was running 8-9%, they were all high-fiving each other in the boardroom at Transurban, right? Because they were getting this big pay rise. Yes, it's got debt and etc. But, you look at Amcor, Brambles, Telstra, these sorts of stocks, APA, again, the tolls for APA's pipelines linked to inflation. You've got to look at the debt side, as Melinda said, but I think just go back to, if you think that's going to happen, go back to what worked in 2022. That was a pretty good playbook, a good place to start.
Price times volume, though, Martin. There wasn't a lot of volume on some of those Transurban roads.
We'll leave that there. Changing tack, just touching on resources, and resources play a critical role at all levels of market capitalisation. We continue to see weaker demand out of China. the government there seemingly unwilling as yet to do anything stimulatory to increase that. And then globally, a lot of rhetoric coming out of the US around tariffs and what Donald Trump might do if he does happen to take office. What does this mean for the opportunities in your in your portfolios as resource opportunities? And I'll kick it off with John.
So I think a statistic that sticks in my mind, and I can't remember the exact numbers, but when the GFC went through the United States, or when the property market melted down in the United States, I think property was around 7% of US GDP. I think that when the Chinese decided to blow their property market up, property accounted for 35 to 40% of Chinese GDP. So I don't think that I have to worry a lot, because I think that shockwave is going to take a very long time to go through, and I don't think that there's the mindset in China to address the problems that has created. I mean, you've got to think about the structure of Chinese society. There's not a lot of social welfare. Property was a store of wealth. It was how people saved for retirement. They didn't trust the share market. Things like that. So there's a lot of impact from that that's working its way through, and I think it also goes to confidence. So for resources, we've tended to focus on particular exposures that have their own story around volumetric growth. We've focused a bit on copper because it's obviously got other demand other than China, and we do actually have an iron ore company, but it's because it's got such high, its iron ore is such high quality that it can be used for direct injection, so therefore it has a green aspect to it. But I'm very wary, it's a consensus position, so I'm not telling you something that people don't know.
Me? Yeah. So with our quality lens on when we look at resources in the small cap space, we only hold companies that are actually able to internally fund their growth. So that means they're profitable. It's really interesting when you look at small cap resources. It is a graveyard of total failures. It's very exciting and a really interesting space, because most of the new minerals come up through the small cap space, and if they're really great deposits, they graduate into mid cap and then large cap. But what's really interesting from our perspective, we've done a long-term study. If you just buy and hold quality small cap resources, so ones that are producing effectively in a diversified portfolio, although you don't outperform the small cap industrial space, you do actually diversify your portfolio and increase the information ratio. And as a result, we're quite happy to hold resource companies. But when we're doing our fundamental research, obviously what we do is we focus on mine life and where they are on the cost curve. So in a situation where China is weaker, for the minerals that are going in there that are not being used for export industries, which obviously EVs and lithium batteries is a bit different, and potentially copper as well. For minerals like iron ore, we're obviously very focused on where companies are on the cost curve and how long their mine lives are, so basically survivability. And then obviously gold is a big space, so it's very different. It's not linked to China or the commodity cycle.
Yeah, it's kind of hard to avoid resources in the large cap end of the market, and one of the reasons we allocate to managers in the small and mid cap space is that we're getting diversification away from banks and resources by doing that. And I'm a huge fan of active small cap managers. They add alpha pretty consistently. But in the large end, you've got 17% odd in 3 iron ore stocks, and then you've got the energy sector at probably 6%. So both of those are sunset industries. I agree with John that China's peak iron ore, peak steel, whatever you want to call it, they're massively overbuilt, and they're getting into a stage of their industrial cycle where they'll start recycling scrap, and so they won't need as much blast furnace material. So, we've seen the best days of iron ore. We've probably seen the best days of coal. We've probably seen the best days of oil. So you kind of not put a ruler through those, because you probably still want to have some exposure, but being underweight that sector has been very positive for returns this year, because the resource sector, a bit like the small cap sector, has been a bit of a serial underperformer. But sort of going forward, I think we don't just have to buy the resources sector. We can pick the eyes out of it. I agree with Melinda on gold. I think gold looks really interesting. We think gold's going to $3,000 an ounce, so there's going to be money made there. I think copper, no matter what your outlook for EVs and the renewable energy transition, you're going to need more copper. There's not a lot of it being discovered. You've seen BHP bid for Anglo. It's pretty obvious that copper's the place to be. So I think you can use a rifle rather than a shotgun with the resource sector. So still maintaining an exposure, but just being very, very careful on the commodity. And also, to Melinda's point, buy a quality asset with a long mine life and a company that has management that's got capital discipline, which is very hard to find in the resources space. So if you can find a combination of all those, you can still be successful, even though the headwinds are probably in your face.
I'll throw to the floor to see if there's any questions from the room.
Questions from the room? Paul, there are always a few reliables.
Thank you. Thank you for calling me reliable. Thank you.
Quality reliable.
So, John, I think some of your data points there about recession, they were very lagging indicators. I mean, unemployment has started to tick up, and guess what? When unemployment's at its worst, it's right in the middle of a recession, maybe 2/3 of the way through. Corporate earnings, again, that is the recession. You don't have weak earnings before a recession. Recession is the fact that the total GDP is lower than what it was last quarter, and that takes time to come through. So those numbers don't really talk to the pending economic circumstance. I'm not saying you're not possibly right. You may well be right, but not because of those data points. And to me, some of these discussion points like Transurban, well, the volumes did rise in 2022 and the prices don't go back down. And so you've got higher prices by a substantial margin. So those defensive characteristics certainly play through. How do you, each of you play to the effect that we've got some very different outcomes potential here with some indicators, forward-looking indicators that are quite negative, despite the fact that the data, as you've pointed out, John, seems pretty reasonable and everyone is playing into that. But the market is saying 250 basis points of cuts in the US. So how do you cover all bases, I suppose, is the question.
So rate cuts are about the neutral rate rather than a response to an economic condition, right? So that's what the rate cuts are actually about. That's why 250 points. Right? So that's why this other inference. In terms of the US data, obviously with employment data, you get a weekly look at it because you have new claims, existing claims, they come out every Thursday. They're still pretty robust. There's not a lot of change. There was a little bit of noise in the unemployment rate regarding the hurricane the month before last. So I take your point, but the reality is that there are live indicators and they're reasonably robust. The recent reporting season in the US was fine, as was ours. It wasn't great, but it wasn't, and you had the forward indicating comments from companies. As I was talking about some of the retailers, I talked to strong demand, or not strong demand, that's an exaggeration, but reasonable demand. So I think from all those people that sit there and look in, it's not what, one area that I do worry about is much stronger in the US than here, and that's business formation. So business formation in the US is very strong. It has been strong since COVID, whereas business formation here is very weak. And I think that's indicative of confidence. That's kind of how, that's part of the thinking. But we're aware of the fact that we can be wrong.
How do we cover all bases? For us, we're in a nice position because we're running a much more diversified portfolio. So given that we hold 115 stocks in our portfolio, we can also then hold buckets of what we think of as core value and growth stocks, which then gives us sort of coverage across all potential outcomes. We also kind of take the view that our mission for existing is to help clients stay allocated to a part of the market that is a source of non-redundant alpha over the long term, right? And so we think of that sort of a short-term question about are we entering a recession or is it going to be a soft landing or something else? that could be either side of that. But we're looking out over a 5-year period, which is sort of what we think of as mid-cycle, and we're focused on, can this company in all sort of market environments continue to grow its earnings, and at what how is the market priced that, and is that reasonable? And we try to stay disciplined and focused on that, with that sort of thing in mind, which is that we can cover all bases by being invested in core value and growth stocks across the baskets for us.
Yeah, I think one of the things here is just diversification, Paul. So not having too much of a macro bet in either direction, particularly when it's really uncertain now. It's like, as I said, if the rate cuts are there because they're just normalising policy back to what they think neutral, and we get this soft landing, then there's a bunch of consumer stocks and financials that are going to do okay. So you want to be invested there. But if it's because they're just late and they've already caused a recession, and the SARM rule and these other labour market indicators it softens and then it cracks, right? Because your customers are someone else's, the people you're laying off are someone else's customers, and it snowballs. And that's typically what happens, right? So you then want the quality growth stocks, the defensives, the high moat companies. So I think the key to all of this is, when the macro environment's as uncertain as it is today, is not have all your eggs in one basket. Have a really well diversified portfolio, whether that's building it bottom up, adding really quality companies that are just going to do well regardless, the Warren Buffett kind of approach, or whether you're not taking too many big macro bets within the portfolio. I think either of those approaches is probably appropriate at the moment.
I met this fellow who's a trader in the United States when I was there, and he pointed out something that really resonated with me, and that's, if you take the S&P 500 and look where it's moved from 2022 to today, those capital gains are real, and people have banked them, and it's not recorded in savings rates and the like, because they tend to go to money market accounts and things like that. You're talking $5 trillion. It's a lot of money, right? And it's in people's accounts. And actually, it's come up in a couple of company meetings we've had where people are financing work through their stock market gains and things like that. So what I'm getting to with that presentation, there's a lot of capital in the world. And so it's already there. There's a lot of capital, and that's helping liquidity. And it may not be in every sector. It may not be in building materials and things like that. They're pretty weak. But it's relatively there. And I think that's one thing that you can see.
Thank you, panel. We are over time, and this is flashing at me. So I just want to thank John, Melinda and Martin for their valuable insights, and thank you for the questions from the floor.